Hi everyone, I'm Jeremy Goodwin, Head of Pensions at Evershed Sutherland. Thanks for listening to Pensions in a Pod, a podcast where we take a look at the latest developments in the pensions world. What we really wanted to share with you here is our insights in terms of what we believe really matters, what's really going on here.
Hello, and welcome to the latest edition of Pensions in a Pod, the Evershed Sutherland podcast, this time on the budget that was announced on the 26th of November. I'm Simon Daniel, a partner in the pensions team here at Evershed Sutherland, and I'm joined today by James Ellis and Jen Green, who are legal directors in our pensions team. And we're delighted to be joined also by Rob Gall, who's the head of market strategy at Insight. Particular welcome to you, Rob. If I could just come to you first, Rob, in relation to the budget. Could you give us your thoughts on how that was received yesterday? I guess including in the 37 minutes before the Chancellor actually stood up to deliver the budget, the dispatch box, and how you think markets will continue to react to it over the coming days, what that means for gilt yields and schemes portfolio positioning.
Thanks, Simon. No, the market reacted very well to the budget. We saw about a 15 basis point fall at the long end of the markets. The long dated bonds did particularly well. They've held on to those gains this morning. We saw bonds outperform swaps. So Z spreads tightened, which is a pretty good measure of how well the government sort of fiscal position is perceived. Sterling was up. But I think that most of the plaudits from a gilt perspective go to the debt management office, not the Chancellor. I think it was the reaction of the debt management office cancelling three long dated auctions and reducing the amount of long dated supply that probably drove the market response. And they were already ahead of their funding if you do it on a sort of per month basis, which gave them the flexibility with these numbers to be able to make those changes. So that's not down to government policy in terms of the amount of borrowing the government's doing. It's just down to good management from the debt office. Although I think if you dig into that, there's a couple of things there that are quite interesting. The very fact that the DMO's done a good job is down to the fact that they've borrowed more in the shorter dated parts of the market. But that obviously brings rollover risk. So whilst everybody's encouraged them to do that because the investor base has changed, clearly pension schemes are no longer buying as many gilts. The Bank of England is now doing QT, not QE. They've had to tilt towards other sectors, foreign investors and banks. It does mean that rollover risk gets bigger because if you fund shorter, you have to refinance. And I think it's quite interesting. If you look at the gilt remit for 27-28, that's up 42 billion, and 29-30 is up 27.8 billion. And that's just down to refinancing. So I think that's something to sort of pick out there. And also, there's going to be a consultation in terms of T-bills and bigger use of T-bills. And again, something that's very welcome. But it does also mean that the gilt market will be funding on a sort of shorter tenor basis. So I just think that the sort of level of refinancing risk is something that we all need to keep an eye on. Whilst the DMO had a good day, I'd say the OBR had a less good day. Clearly, that was a bit chaotic with the release of that in advance. It was one of the most easy budgets from that perspective for us in the market because it's the first time we've had it before the Chancellor stood up, and also we've had AI. So you could just stick it through and you really could pick down to the point. So I think the market reaction was probably quicker than it's ever been. In terms of the budget itself, yes, she's given herself some headroom. I think moving to one OBR sort of event a year in terms of looking at the fiscal rules will probably take a bit of the pressure off. But when you back end load everything and it's done on the basis of forecasts, there's a lot of risk there. So I think from a gilt market perspective, in the short term, the fiscal sort of issue has been put on the back burner. We've been waiting so long for this budget. Everybody's pleased to have it behind them. And the market's kind of got through scot-free. But when you roll the clock forward in 6 months' time, when we've seen more growth numbers, we've seen how the sort of the things are playing out versus the forecasts. I think that headroom is going to start to be diminished. And as a result, we'll get back to that being another issue for the market. The last thing I'd say, though, is that, so for now, the market's going to stop looking at fiscal policy. Clearly, monetary policy, there's only another cut there's a cut in December and then another one after that priced in. But we're all going to be looking at political risk. And clearly, with the local elections and the position that Starmer and Reeves seem to be in with the Parliamentary Labour Party, that's not gone away. So I think the gilt market will just move on to a different thing to worry about.
Thank you, Rob. That's really interesting. And just one point occurs to me for those listening is if you're a scheme that's looking to run on for a period, perhaps deferring a decision to do a bulk annuity transaction, you're thinking about that period up to late 2020s, 2030s. Would you regard the sort of rollover risk that is potentially building up as something for those schemes to particularly think about in terms of their investment strategy?
I think that pension schemes always need to be alive to what's going on in the gilt market. I think it's quite easy to think you can buy a hedging portfolio and fire and forget and think that that means that you've done the job. And actually, the gilt market's always changing. There's always new risks that are around. There'll be new bonds issued. The structure will change. So as a result, I think that, yes, you do have to be alive to that risk. And as a result, you do really need to keep your portfolio not sort of active, but with a very close eye in terms of, taking advantage of opportunities and making sure your manager has the flexibility. I don't think this rollover risk is a serious fiscal problem for the UK because it's pretty well flagged. We can see it when they issue the bonds, but I do think it will change the pricing of the curve over time. And that's something that you can either ignore or you can take advantage of.
That's brilliant. Thank you, Rob. That's great. And I guess then just pivoting a little bit more into sort of more mainstream pensions topics. And Jed, if I could come to you next on the couple of things that were announced in relation to surplus payments to members and also increases on pre-97 benefits of PPF and FAS compensation. I think the first one probably the industry had asked for, but it's come through perhaps not in the form we'd ideally like. And the second one was a complete surprise, I think, even though the issue of pre-97 indexation had been discussed. So what are your thoughts on that, Jen?
Yeah, I think that's a fair summary of the two sort of big headlines for DB schemes. So if we start with the payment of surplus to members, which was probably the first big announcement. So the Chancellor said that from April 2027, schemes will be able to use surplus to pay one-off member lump sums. So that will be helpful for trustees because as compared to other sort of benefit augmentations or increases they'll be considering, that type of one-off lump sum just doesn't bake in those additional liabilities that employers and trustees may have concerns about for ongoing schemes. So helpful in that sense. We have limited information about what this lump sum might look like, particularly from a tax perspective. But the sort of snippets of information we have is that the sort of two key conditions in terms of being eligible for one of these lump sums are that the schemes and rules must allow lump sums to be paid, but presumably be quite easy to amend your scheme rules to make this option available. And secondly, that the member is over minimum pension age. So those are the two key conditions. And so this all neatly ties in with the surplus changes that have been included in the pension schemes bill, which give schemes the power to pay surplus to sponsoring employers. So it's just that additional member option that we'll now have. So that was the one announcement which we were sort of all generally expecting. But the second announcement that you mentioned was the shocker from a pensions perspective. So this is the announcement that PPF and FAS compensation will cover increases on pre-97 pensions. And the Chancellor said that from January 2027, increases of CPI up to 2.5% would be applied if the original scheme provided pre-97 increases. And following the budget, we had an announcement from the PPF yesterday to say that this change could benefit more than 250,000 members who are receiving compensation. So it would have a material impact and is a big win for the members. I guess the flip side of that is, what does this mean for levy payers? And I think that probably remains to be seen, although the PPF has made some sort of positive noises and said that suggested that the PPF could absorb the cost of this additional liability without impacting its plans to set a zero PPF levy next year. So it feels like we're safe for another year, but remains to be seen what the long-term impact could be.
And then just on the FAS PPF compensation one, is there any indication, do you think, that government will apply the same sort of thing for DB schemes and looking to use surplus, say, like, you've got to give pre-97 increases to members there?
I think, yeah, there are certainly rumours swirling, aren't there, that there's potentially additional changes that can be made. And regardless of whether that makes its way into the pension schemes bill, I think it still makes the discussions between sponsoring employers and trustees on surplus more interesting and potentially more challenging. So, and whether, discretionary pre-97 increases should be applied. So it definitely brings that conversation more to the forefront, I think. But yeah, it'll be interesting to see how this plays out in the non-PPF world.
Brilliant. Thank you, Jen. And then, then on to you, James, for the tax bit. So salary sacrifice, I think, came through much as expected. And then there was something on inheritance tax, which looked helpful for PRs and less helpful for trustees of schemes. What are your thoughts there?
Yeah, thanks, Simon. I'll start with salary sacrifice, and as you said, this one has been well trailed and really did come in as expected, in that salary sacrifice pension contributions above an annual £2,000 threshold won't be exempt from national insurance contributions. Plan change is due to come into effect from April 2029, and I think you can probably all breathe a little bit of a sigh of relief. There was some concern that they were going to try and implement it much sooner, which would have had everybody scrabbling around and panicking a bit. But we do have actually some years to go. And obviously there'll be a lot of detail to come. And that time gap does potentially mean and leave scope for things to change a little bit. Kind of economic climate can change, details can change. So you never know. But let's assume that the changes do go ahead as announced. I guess the key question is how do we see employers and members reacting to this? I think the main concern here is that employers are likely to think about reducing their own contribution rates. They obviously still need to comply with automatic enrolment minimums. But at a time where it's widely recognised across the industry that UK population are going to be poorer in retirement, where you have a situation where employers are looking to reduce their own contributions, that's obviously not an ideal situation. And it'll be also really interesting to see how that all plays into the Pension Commission's ongoing review of adequacy of pensions benefits in retirement. Could be a knock-on impact on other employer benefits as well. Employers might seek to reduce other employment benefits to offset the increased national insurance cost. And there might just be a more general concern that other benefits which are currently subject to salary sacrifice might come under scrutiny in future government reviews as well. There's another possibility that employers might seek to replicate the effect of a salary sacrifice scheme by reducing future wage growth and providing employees with higher employer pension contributions. I've seen that being spoken about. There's a lot of complexities with that need to be really carefully thought through. For example, it's not clear that employees would be able to have the same ability to opt in and out of that you'd have with a normal salary sacrifice scheme. And also agreeing to a lower salary could have a direct knock-on impact on other things like mortgage applications, other benefits, redundancy, payouts, credit ratings, and so on. And of course, you'd be having to really think through kind of communication, consultation, and contractual aspects of that as well with your workforce. Moving on to IHT, which is I think a shorter announcement, but there was a change from what they proposed in July. And now that personal representatives are going to be able to direct pension schemes to withhold 50% of taxable benefits for up to 15 months and pay any IHT due before releasing the rest of the benefit to the pension beneficiaries. I know this is something people have been asking for. Personal representatives, I think, have been a bit concerned that under the proposals, they're ultimately responsible for paying the IHT due, but potentially might not actually have the assets available to meet the tax. So I can see it being helpful from that perspective. My main thought or concern with this is actually, could this lead to further delays in settling death benefits? Could cause issues for beneficiaries who might really need the money at the time. And obviously trustees would then really need to be kind of carefully managing expectations. And it could also cause issues for trustees, for example, if they're trying to wind up a scheme and they've got this, which potentially means that they've got to continue it for 15 months while the person representatives are sorting things out. We're expecting updated final legislation on the inheritance tax changes very shortly. So that will give us a chance to kind of work through all of the detail and hopefully we see that it's drafted in a way which actually is going to make practical sense.
Thanks, James. Hopefully. I know that IHT legislation has been sort of long in the making in terms of the proposals and all the industry feedback the government's received, hopefully thought about as well. And this is another wrinkle to add to that. I just wonder on salary sacrifice. I mean, do you think that because there's such a long lead-in time for that change, that actually the government might not realise the expected tax revenue that it's expecting, the tax revenue that it's forecast in the budget, because people will just plan around it and kind of make different arrangements?
Quite possibly. So they've forecasted it to raise 4.7 billion in 2029 to 30, and then 2.6 billion in the following year. So there's some very chunky numbers there. But you're right. I mean, everybody's got a lot more time to think about it and to work out workarounds. So potentially that doesn't work out. And they have the forecasting has been clear as to kind of some of their assumptions about what employers might or might not do. So it will be really interesting to see actually if these workarounds get around that. There is also the risk that if there are too many workarounds, they might start looking at it as some kind of disguised remuneration scheme, kind of tax avoidance, and then you start seeing the revenue starting to clamp down on that. So again, it'll be interesting to see how that all plays out.
Thank you. And I did notice that the government, I think, said they think this change of salary sacrifice will not impact about 75% of basic rate taxpayers, but the converse obviously means it will impact 25%, which is fairly hefty number. So yeah, we'll have to see how that plays into discussions around adequacy and pension saving generally.
Oh, absolutely. I mean, I've seen statistics which I think say kind of a third of private sector employees are in salary sacrifice schemes. So there's potentially a lot of people which this could catch.
Fantastic. Well, thanks to you both, Jen and James. Thanks also to you, Rob. That's great. I wonder if we could just do a quick whiz around the table and capture the key points for listeners as an action or a point to consider immediately following the budget. Rob, we'll come back to you first.
Yeah, thanks, Simon. I think the key takeaway for me would be that the gilt market continues to face quite a lot of risk. There's, clearly political elements out there in terms of where does the Labour Party go. I was really interested to hear James's point there in terms of whether the government actually raises the revenue it thinks. I mean, as I said before, the forecasts are all back end loaded, so I think that headroom could disappear quite quickly. So my point would just be expect volatility in the gilt market and make sure that your portfolio reacts to it rather than just sitting there passively and misses out on what could be a period with potentially some pretty good opportunities.
Thank you, Rob. And James, for you, please.
Yeah, so I guess from salary sacrifice and the IHT is really just keeping things under review as things go. It'd be interesting to start thinking about from a salary sacrifice perspective what that means for you, what that means for your costs, and kind of potential ways of mitigating that. And the IHT is really just keeping an eye on the final legislation and understanding from a trustee scheme perspective, kind of what that means and what the processes which need to be implemented during the course of next year.
Fantastic. Thank you, everyone. We've covered a huge range of topics there on, and it's necessary to do so on something like a budget. So that's fantastic. Thank you, everyone, for listening. We have put a speed brief out. We did that later on budget day. So if you want to read about any of the detail here, please do refer to our speed brief. And thank you for listening.
Thanks all for listening to this latest Pensions in a Pod episode. To access previous episodes, please have a look at our website, on Apple Podcasts or on Spotify, where you can find them all stored for your enjoyment. We look forward to coming back to you in a month's time to give you the latest insights on what's really going on in the legal pensions landscape.